What's up, guys? This is Irene Aldrich from my amazing recording studio. As you can see in the back here is a copy of our brand new book, Big Data Science and Finance. I hope you got yourself a copy by now, but if you didn't, just go ahead and buy one. And today I'm going to tell you why you should do that. One of the reasons is because we cover clustering in great detail in chapter 9 of our book. So clustering, specifically, we focus on spectral clustering. But to understand spectral clustering, you really need to understand k-means clustering. And this is what I'm going to talk about today. If you want more details on spectral clustering, last Wednesday, I gave a webinar for Talesians in London. I think my content is available online with them, so you may want to check that out. But let's just focus on k-means for today, because spectral clustering uses k-means clustering as an input. Okay, so let me share the screen. So this, by the way, is our book's website. Okay, if you haven't been to our book's website, you absolutely have to go. It's bigdatafinance.book.com, one word. Okay, Big Data Finance Book. So this is the website. You have about reviews. We have fantastic reviews. We're very grateful for those. This is the cover of the book. You can just click here to go directly to the Amazon page to order your copy. We have these amazing, absolutely amazing reviews for which we're grateful. And we have a great table of contents. We basically are covering all the important concepts in data science while we're applying them to finance. So this is really a groundbreaking thing that pretty much nobody has done. And here's the code section. Okay, so we have code accompanying every chapter, and you should check it out. You do need a password from the book to get to the code. Okay, and I'm going to talk about this clustering code shortly. But also, most importantly, you know what we have? We have merch. And this is a t-shirt. If once you own or read a copy of the book, you should get this t-shirt. On the front it says, I read Big Data Science and Finance, dude. And on the back it has a copy of the book. All right, so obviously this is intended to be lighthearted. So anyway, so today's Friday night, so you have something to do and think about over the weekend. Here's some code for you on k-means clustering. So what does k-means clustering do? Well, we discuss it again in the book in great detail. And essentially what it does, it's computing distances to what's called centroids, or tentative centers of clusters. And then once this algorithm does that, it recomputes the centroids based on how many points it clustered into which cluster. Okay, so but what's essentially k-means does, it draws kind of borders among data. All right, so and it's these borders are called cuts, and it's basically cuts the data set into convex clusters. Convex meaning they're bounded. All right, so and that's a limitation of k-means. It's a very simple algorithm, but it's also its limitation, because, like, for example, when you have concentric circles, k-means cannot handle it. For that you need spectral clustering. Okay, that I'm not going to talk about today, but we've talked extensively about it in the book. All right, so today I'm just going to talk about k-means and what you need to do to program it. So if you look at the screen, and I'm going to make it bigger so you can see it better. All right, so the first thing you need to do is really install Scikit-Learn. That's free toolkit, Python toolkit that contains a lot of data science algorithms. So you just do python-m pip install sklearn from your command prompt. But we're going to use k-means on today is a Mean-Variance Frontier for Russell 1000. And you would ask, why would you do something like this? And the answer to that is, why not? You know, you can use it on anything, really, something that's you would like to cluster. Now, my hunch is, and this is our Mean-Variance Frontier for February 2021. So for every trading day in February 2021, we compute daily return for Russell 1000. And then we plot So on the x-axis, we have standard deviation. That's over the entire month of February, so about 20 trading days. And on the y-axis, we have February return. Okay, so this is what our mean variance frontier looks like. This is average return. Sorry, it's average February return, daily return. Okay, it's not the monthly return. So bottom line, this is what our mean variance looks like. And maybe we're trading options, and maybe we're very interested in finding out, is there any way we can slice these different asset types in order to create a better options trading strategy. So let's see what we can do. But to run k-means, first we're going to, in our Python code, we're going to import k-means from this Scikit-Learn library. Then we're going to instantiate the model. Here we're just going to go for 3 clusters. And why do we go for 3 clusters? Well, perhaps we want to separate the entire data set into something that, yes, we definitely trade with options, something we don't trade with options, and something we trade with options under certain conditions. All right, just very basic. Here is our matrix, is just the standard deviation and mean of returns. Okay, and in every row we have the every row represents of X represents individual stock. Okay, and the first column is standard deviation, the second column is mean returns. And all we need to do to develop this clustering model is say k-means fit, and we fitted this matrix X. And then if you want, you can print cluster centers and data labels. Data labels are going to be 0, 1, 2, corresponding to the 3 clusters. And then we're going to plot them, okay? So we're going to use Matplotlib to actually plot these clusters. And here I just made the font a little bit smaller so you can see the entire code. Everything is very simplistic. And this is our result, right? So this is how k-means clusters mean variance frontier for Russell 1000. So you have the first cluster, which is basically very low standard deviation. Okay, so that's in green on the left. And you have basically medium standard deviation in the middle, and then you have a couple of points in the top right corner that correspond to extremely high standard deviation, also correspond to high returns, because as we know from classical finance, higher volatility or higher risk has to lead to higher returns. So and maybe we can exploit some of the low or high volatility, low return here and do some arbitrage as well. But anyway, it's not the point of the talk. The point here to really show you how this is done, and you can see it's very basic, and the clustering is really based on very straightforward cuts, right? And that's it. So now you can try it yourself, and you can measure the performance of clusters versus future options prices. I think it's a very interesting application, and that's all, folks. All right. And again, we have different videos here for other algorithms that we have included in the code. There's some other media. There's going to be more uploaded shortly. And of course, we have our amazing shirts in different sizes. Okay, so I'll see you soon, guys. Have a great weekend and enjoy k-means. Take care.